Hi everybody, thanks to everybody who's after joining us so far and for registering for the webinar. I hope everybody's year is off to a good start and you all enjoyed the Christmas break, although it seems like a bit of a distant memory at this stage. My own name is David Looney. I work as a financial advisor with Alpha Wealth, and today's webinar is just going to be a quick, I suppose, kind of January kickstart to give you guys some takeaways and how you can implement some steps to improve your own financial position and, more importantly, your financial future. For those of you who might be on this webinar for the first time, we have been doing quite a lot of these free financial webinars over the last couple of years or so, and we will be doing many more over the course of 2024. So you can kind of keep an eye on our social media channels and we'll be updating you on the details of any ones that might take place over the course of this year. I will be doing one myself in early February, and look, there'll be many more as the months go along. And thanks to everybody as well who might be watching this on recording. So we'll get into things. Just to start off, if anyone on the webinar is not familiar with Alpha Wealth or might be on our webinars for the first time, we basically run a impartial financial planning and advisory company. We've 8 qualified advisors in Alpha Wealth, both QFA and CFP qualified, and we provide specialist advice and solutions in pretty much all areas of personal finance. So things like savings and investments advice, financial planning, retirement planning and pensions, tax advice, protection, mortgages. I'm happy to say at this stage we're coming up to our 10th year anniversary, which we will be celebrating this April. And over that period, we've amassed over 4,000 clients from throughout Ireland who now have over 250 million of assets under management with Alpha Wealth. So myself and my colleagues have quite a lot of experience in helping people like yourselves, manage your money more effectively and, plan your financial futures. You can see some of my colleagues on the right-hand side who I actually am joined on the webinar today by some of them. So just a reminder, if anybody has some questions over the course of the webinar, you can just pop them into the Q&A box and we'll do our best to get to them either throughout the webinar or else we'll leave a bit of time at the end as well. So I always think January is a fantastic opportunity just to kind of take a step back and take stock of where you are personally, but also financially. And it's a really good time of the year, obviously, just to put some habits in place, whether that's financial habits or otherwise. When we do financial planning consultations with clients and we put financial plans in place, obviously, there's the financial benefit that clients get from that, but I think there's also a massive understated kind of mental or well-being benefit that comes from knowing that you're now in control of your financial situation and feeling confident about your financial future, having a clear understanding of what you're trying to achieve over the course of your life and knowing that you're taking the steps needed to reach those objectives comes with a massive sense of well-being. If we look over the last couple of years, I think it was easy to, look for reasons to be negative. There was a lot of doom and gloom out there, but I'm happy to say that there is some positive news for our finances in 2024. So what has changed between this year and last year? The big change has come in the budget last year, so budget 2024, where the government increased the higher rate income tax threshold from 40,000 up to 42,000, and they also made some changes to the USC bands. So what does that mean for a bottom line? Thankfully, it means that most people, if not everyone on the webinar today, is going to be financially better off this year. So for instance, if you are a top rate taxpayer, a single person, let's say earning a salary of €60,000 per year, you're going to be better off to the tune of about €70 per month. If you were a married couple that have maybe a combined income of 100 grand a year, you're going to be better off by about €130 per month. In addition to that, those who saw their their mortgage repayments go up last year through the rate hikes that we've seen, so those on like tracker or variable rate mortgages, you now have the opportunity to claim back €1,250 in your tax return at the start of this year. And we have all got the additional €300 in energy credits at the start of this year, plus the 150 that we got in December last year. The government also increased the rent credit from 500 up to €750, and that's per person. So if anyone on the call is maybe in a couple who's renting an apartment, let's say, that's €1,500 that you can claim back between the both of you. That might even cover, 1 month's rent. 25% reduction in childcare costs, which was badly needed, and a reduction in college fees for families earning €100,000 a year or less. Also, good to note that signs of inflation are starting. There are signs that inflation is starting to cool. I think inflation at the moment is running about 2.5%. That's compared to 9% last year, and it does look like central banks are ceasing to hike up interest rates, which is obviously good news for the tracker and variable rate mortgage holders. And finally, it does look like energy costs are also starting to reduce. So for most people on the call today, as I said, you're going to be in a situation hopefully where your income is a bit higher and your expenses are a bit less. So if you are up money this year, and as I said, most people will be, it's a really good time of the year to put good habits in place before something called lifestyle creep comes in. Now, lifestyle creep basically means that once you get more income or more money, your lifestyle adjusts to eat up that extra income before you even know it's there. For anyone on the call who might have got a couple of pay rises over the last couple of years and it seems like they're still living month to month. Now, part of that obviously is through inflation and the massive rise in cost of bills and stuff that we've seen over the last couple of years, but a lot of it is lifestyle creep as well. We start eating nicer restaurants, we look to drive nicer cars, move into the bigger house, and before we know it, all our extra income is eaten up. So it's important to put some of your income to the side. And there's two really easy, I suppose, things that people can do this year that would have a big impact on their financial future. And it mightn't necessarily cost them, or they might notice the cost of that. One is that if you're a top rate taxpayer, you can actually increase your pension contributions by €120 per month this year. And believe it or not, your January 2024 payslip is going to be much the exact same as your December 2023 payslip. What I mean there is we mentioned that people are going to be up by about €70 per month. On average, €120 extra to your pension after the 40% tax relief will be a net cost of about €70 per month. Another big financial burden for a lot of parents is third level education costs, which are expected to range anywhere between, say, €26,000 to €66,000 per child, depending on whether they're, renting whilst they're in college. So as we said already, a lot of couples would be up by about €130 per month this year. Why not decide to put that €130, €140 per month into a long-term savings plan for your child's future? And so there are two things that you can do instantly this year and not realize the cost of it versus the position you were in December just last month. So if we take a step back from the long-term financial planning first and just talk about, implementing good day-to-day financial habits, two things that I would encourage everyone on the call today to get into the habit of doing is firstly doing budgeting on a regular basis, and secondly, get into the habit of trying to always reduce your main financial costs and claiming tax back. I think budgeting is a really good exercise for everyone, irrespective of your income levels or your situation. I think everyone on the call today will appreciate that it is really important to put money aside money to the side for financial success. And what a budget will do is help you track your income and outgoings to identify what your saving scope is. I always tell people to get into the habit of paying themselves first or get their savings out of their account first. So it's really a case that you're kind of mapping out how to spend maybe 80% of what you earn by allocating 20% to savings and investments first. And obviously by reducing your costs, that's going to help you in that process. And it might even be a case of kind of starting your savings and investments goal small and trying to build on that as the years or the months go on. And we do have a really good budget calculator on our website. It's a free tool, alphawealth.ie, if anybody wants to check out that, a really good tool there for doing a monthly budget plan. Also, as I said, get into the habit of reviewing all your main financial outgoings, trying to reduce your costs and claim tax back on everything that you're eligible to claim tax back on. So just some easy examples that we can look at, the low-hanging fruit, things like mortgage repayments. Yes, interest rates have gone up quite a lot in the last 12 to 18 months, but I do still come across a lot of clients that can be doing a bit better. So if anybody on the call today is paying an interest rate of more than, say, about 3.5%, there might be a possibility that you can move on to a lower rate and therefore reduce your monthly outgoings. For instance, you might have a property that qualifies for a green rate, which are typically lower. That's a property that has a BER rating or B3 or higher. Mortgage protection policies. I still meet a lot of clients that are paying, over 100 quid a month for mortgage protection because the bank sold them a policy that they don't really need, or a very expensive policy. So Alpha Wealth can help you in reviewing that and trying to, reduce the cost in it and get the cover that's right for you and appropriate to your situation without overpaying. Obviously, things like, home insurance, car insurance, health insurance, really shopping around, availing of online discounts. And when it comes to things like health insurance, you can avail of certain kids offers whereby you pay for one child and all the rest go free. Loans, I regularly meet people that are paying, 6, 7, 8, 9% interest on a loan, and then have money sitting in their current account or their credit union earning nothing. Take the money, clear off the loan, free up the repayment, and save yourself some interest. And finally, as I said, look out for all the tax reliefs and credits that you can claim, whether that's 20% back on your medical or dental expenses, the rental credit of 750 per person, as we already mentioned. If anybody has been working at home for the last couple of years, they can avail of e-worker relief, which allows them to claim 30% back of utility bills if they're working from home. And then we have things like, flat rate expenses for people in certain occupations, or claiming back on tuition fees. So once we've got our financial house in order and we've done that kind of day-to-day stuff, it's about kind of taking a step back and really, trying to decide what are we trying to achieve. You're a certain age, you're earning so much per year. What's the end goal? What are you working towards? What do you want to achieve, essentially? And we hear different things from different people, and things like becoming debt free, saving money to buy a property, and building up a bit of a nest egg or a portfolio, saving for kids' education, saving so they can retire at a certain age. It might even be a combination of all the above. But I think what we can all agree on is that most of those things will involve building up financial assets or creating wealth. So it's really important that everyone has some element of a roadmap on how they're trying to achieve these things, rather than just kind of, blindly maybe putting money into a bank account every month or a credit union, not knowing, what it's intended for or what the long-term plan is. So really important for people to have that financial plan. And you'll notice that the road I've chosen on the right-hand side is not a straight road, because people will go through changes in their life and financial plans do need to adjust, which is why it's really important to get professional advice. So the way I see it, from my experience, there's three massive challenges for everyday people in terms of challenges to prevent us accumulating large levels of wealth to achieve our goals, outside of course, our ability to earn, or, the income that we're on. The first one, of course, is tax. We lose 20% or 40% of our income to income tax, combined with USC and PRSI. That takes quite a lot out of our pocket. If we then save our after-tax income into, banks, credit unions, savings and investment vehicles, ETFs, funds, you name it, we'll pay a further 33% or 41% on that tax. So what's the solution? The solution is to utilize tax efficient vehicles like pension schemes, which actually allow you to save your gross before tax earnings rather than your after tax earnings. And not only that, but they allow tax-free growth on the interest earned. And contrary to, popular misconceptions, you can actually access most pensions from early as 50 onwards. So a really efficient way to accumulate large pots of money over time. The second challenge is that most people I meet, not most people I meet, but a lot of people I meet, they still, only stick to kind of banks, credit unions, An Post for their regular savings. And whilst these institutions are fine for kind of short-term savings, we need to be realistic that none of them pay decent interest. So you're always losing value on your money in real terms. And as a result, it's almost impossible to generate a meaningful level of wealth as a result. So the solution, of course, is to start educating yourself on investing and allow yourself to make an informed decision on where your money is going. The third, as we mentioned earlier, is inflation. Inflation is the rate of the rise in the cost of goods and services over time. It historically averages about 3% per year. So if you think about everything you bought last year, it's going to be about 3% more expensive this year on average, and 3% more expensive next year. So if your money or your long-term savings is not earning a net return of at least 3% per year, you're going backwards. So you need to always look to gain positive inflation beating interest on any of your medium to long-term savings. And you're not going to get that in any banks, credit unions, or An Post, unfortunately. For everyone on the call, and I'm not being dramatic here, unless you win the lotto or earn and save huge levels of income, you will never reach financial independence early if you ignore these three challenges. And if anybody doesn't believe me, I'm going to look at a quick example. So if we take Mary here, who's age 30, and she's saving €1,000 every month to her bank that are paying her a net interest rate after tax of 1% per year, we'd expect Mary's income to increase over time. So we're going to assume that she increases her savings by 2% per year also, and she doesn't have a pension. After 25 years of saving €1,000 a month, increasing it by 2% per year, and earning a net interest rate of 1% per year, Mary's account is going to be worth 444,000 by the time she's 55. Now that might seem like a lot of money in today's terms, but when we discount that back to allow for inflation of 3% per year, in today's monies, what it would buy today would be worth about 212,000. So considering Mary's expected to possibly live for another 30 years because people are living a lot longer now, is 212,000 enough to give up work and be financially independent? What level of income would a fund like that provide before Mary runs out of money? The answer in today's monies is about 8 grand a year, which I'm sure most people on the call would appreciate is not enough to be financially independent or to live, a comfortable life in their retirement if they do want to reach financial independence early. So even though Mary's saving €1,000 per month, she's missing a massive opportunity. In contrast, if we look at John, who also saves €1,000 per month of his take-home wage, but he puts it to a tax-efficient vehicle like a pension. So what he's actually getting hitting his pension account each month is not €1,000, it's €1,665 thereabouts. What I'm referring to there is that if John pays €1,665 each month into his pension, after his 40% relief, the net cost to him is €999, so about €1,000 per month, same as Mary. Now, if he invests that in a fund over the long term, earning an average 6% per year, and remember that growth is tax-free because it's in a pension, John's actually going to come out with a fund of about 1.4 million, or about 680,000. So the difference to Mary's fund above, despite them saving the same net amount on a monthly basis, is a difference of nearly €1,000,000, or about 468,000 in today's monies. Now, I'm not saying that people should not save money or that you should plow every available cent into your pension, but it's about, focusing on what you're trying to achieve in your life and picking the best available option for that particular money. So the three most common questions I get asked when it does come to pensions is, firstly, how much can I pay into a pension? And it is dependent on your age and your salary. So for those who are age 30 and under, they can pay 15% into their of their income into a pension each year, and that rises gradually up to 40% for those who are 60 and over. It is, however, capped at €115,000 per year of income. So if you're earning 150 grand a year, you can still only pay in, say, 30% of 115k if you're between age, 50 and 55. It does not include employer contributions as well. A lot of people get tripped up on that. Sometimes I meet people and they say, "Oh, David, I'm maxing out my pension," and they're not, because they're including their employer's contribution, so they can actually go a bit more. How much should I pay into a pension? My advice is to get as close to the above figures as possible without, locking yourself inside the door and not being able to enjoy life. And it might even be a case of start something small, put those habits in place as we referred to earlier, and look to increase and build on that every single year. When can I access the pension fund? Typically from age 50 onwards in most cases. People sometimes think that you have to be paying into a pension until 60 or 65 or 68 before you can get your hands on it. Not the case at all. Now, I think the reason some people are a bit reluctant to maybe pay money into pensions or investments in general is because they're concerned about risk to their capital, which is very, very natural. Now, Zurich, who many people might be familiar with, are the biggest pension provider in Ireland and one of the biggest investment providers in Ireland. And what I've shown here is a bar chart of their balance fund, which is one of the oldest and most popular funds in the Irish market. And what this chart shows is every 5-year rolling period dating back to 1989. So we have a total of 35-year rolling periods over that 33-year period since 1989. And what you'll notice is that we've only seen 2 occasions out of 30 where the 5-year annualized performance was not positive. And when you look at the fall, it's less than 5%. And the chances are, of course, if that person who was in the unluckily in that 5-year rolling period, if they had held the investment for another 6 or 7 years, they probably would have been back in positive territory. So what people don't understand, or a lot of people don't understand, is that the longer you hold your investment, you're significantly reducing your risk. And this is why we always encourage people to invest their medium to long-term savings. So that's, savings that you don't need in the next 5, 6, 7, 10, 15 years. Just to emphasize that point again, this is a chart which shows the uplift in the performance of that balance fund. And you'll notice that there is a lot of ups and downs over short-term periods. And there's a bit of description on what might have caused that here. But you'll notice that the trend is always going upwards. Even for somebody who invested right before the financial crash in, say, a pension or an investment fund like the balance fund, 10 years later, they would have been up here. So even though they invested right before probably the biggest financial crash that we've seen in decades, they would have been significantly up in value if they just held their investment for 10 years.
David, sorry to interrupt you there, but someone's just put a question in the question box. How much percentage of my salary should I put into my pension?
It's dependent on your age really, and like how much other pension assets you've built up. So like for instance, if I meet someone who's age 50 and they want to retire at 60 and they haven't really funded pensions much over their life, they've little to no money in pensions, for that person to accumulate a meaningful pot, they're obviously going to need to put in more money than the 30-year-old who has a 30-year time frame ahead of him. Do you understand? But as I was saying earlier, the advice to everyone is to maybe get as close to these maximum percentages as is possible, or do what you can, have a look at, maybe do a bit of a budget calculator, as I said, look at your income, look at your expenses, see what your disposable income is every month, and try to put some of that to a pension and look to build on that every year. Usually I would say maybe someone starting off and let's say they're 30s, if they can start off at maybe 10% of their income, probably a good place to start. And as I said, try to build on that. But the honest answer is like there's no wrong amount. Like it still makes sense. Like even if you can only afford to put 5% of your income into a pension, it still makes sense, because if we go back to the numbers between these two people, it's still a far greater return on investment and than just putting money into a bank, credit union or post office, and there's far better tax advantages from it. So it is the most efficient way of saving money long term. So there are a lot of investment funds or pension funds in the Irish market, and the good news is that like over a medium to long term period, the vast majority of them have gone up in value, but there is a massive variation between the actual returns that funds have given. So what I've done here is I've actually compared a couple of funds of various fund managers in the Irish market. So your main life companies like Zurich, Irish Life, Aviva, New Ireland, and Standard Life, which most of the people on the call should have pensions with or might be familiar with. All of these funds are risk rating 5. So that's 5 on a scale of 1 to 7. We would call that a moderate to high risk fund. And it's probably the most popular pension fund because, it would probably suit anyone who's in that kind of age 30 to mid 50s cohort, to being honest, depending on when they want to retire. So all of these funds are comparing apples to apples. The Zurich Prisma 5 has done 68% over the last 5 years, compared to the same risk level Irish Life Fund has only done 28%. Aviva 35%, New Ireland a bit better at 48, and Standard Life again at 35. So you can see the Zurich Prisma 5 has actually doubled the performance of some of its competitors, despite being the same risk level. And so the advice to everyone on the call is to always ensure you're getting access to the best available. If you have pensions with some of these other providers, we can review those for you and give you independent investment advice to make sure that you're availing of the best options available to you. And there might even be a potential, obviously, to move to better performing funds during that review. So pensions are obviously great for long-term savings, but if you need to save for that car in 5 years' time, and you need access to your money, it's obviously not very helpful, is it? So where can we save over that, say, 4 to 10 year period? to outperform inflation and get access to our money. There's brilliant long-term savings investment plans in the Irish market offered through some of the various insurance companies. My preferred plan is through Zurich, and let me just state that we've no vested bias in recommending Zurich. We're not tied to them. We deal with all the fund managers and providers, all the main ones in the Irish market, but my own pension is with Zurich, my own savings are with Zurich. I believe they are the strongest fund manager in the Irish market, but they have a brilliant account called the Zurich Easy Access Savings Plan, which basically allows people to save on a monthly basis from as little as €100 per month or as a lump sum, and you can access the money at any stage. The term is completely open-ended, so you can, increase, decrease, stop and restart. And it basically allows you the ability to get exposure to some of Zurich's funds. There's different risk and reward level funds, so there's something there for everyone. The balance fund that I showed earlier would be an example of one fund. Two funds we might typically look at would be the active asset allocation fund, which is moderate risk, and the balance fund, which is moderate to high risk, but both very, very well diversified. And over the last 5 years, both funds have returned about 50% gross. So we talked about pensions, obviously, in terms of, really tax efficient, but long term. And we talked about savings that would, beat your bank account and beat your credit union, but don't offer tax relief. So is there a way to get tax relief on some of our savings without needing to tie it away for a very long period of time? And the good news is that there is a scheme called the Employment Incentive Investment Scheme, or EIIS for short. And basically what it is it is a revenue-backed tax relief scheme whereby investors can invest in qualifying Irish companies over a 4 to 5 year period and qualify for a tax rebate on their investment amount up to a maximum of 50%, depending on the company. The minimum you can invest is usually €5,000. So the benefits, as I said, is that you can invest in, a whole host of qualifying Irish companies every single year, and revenue will return you somewhere between 20 and 50% of your investment amount as a tax rebate in the following year. And then you have the potential to earn an additional return from the company over that 4 to 5 year period, which is typically in the region of about 20 to 30%. The EIIS scheme is the only thing that exists in Ireland to get tax back at a high level outside of a pension, and it is a really, really powerful scheme. We have been working with EIS companies for a number of years in Alpha Wealth, and these are some of the companies we've worked with on the right-hand side. So Blacks of Kinsale, fantastic whiskey, gin and craft beer company located in Kinsale and Cork. BVP, who run a renewable energy EIS fund every single year. 5 Mile Concepts, who are after taking over and redeveloping the 2 Mile Inn pub and restaurant outside of Middleton and Cork, and have put in a coffee roastery there, so they're selling 5 Mile coffee, and they're launching a new bar, restaurant and cafe to the market this spring. Dairy Concepts, who make dairy snacks, and Kinsale Spirit Co, another whiskey company. It tends to be quite popular with whiskey companies. If anybody is interested in exploring this as a way to generate a return on investment and reduce their tax, we will have some 2024 EIS options available, including 5 Mile, who are raising funds again this year. So feel free to link in with us and we can talk you through that process.
Sorry to just quickly interrupt you there, David, but someone's just put in a question. How to get max 50% tax relief on EIS?
So it used to always be 40% relief, okay? So everyone that invested in EIS would get 40% relief if they were a top rate taxpayer. But last year they made some changes to the scheme where it's kind of a tapered down relief, okay? So my understanding is how it works is, let's say if you are a new to market company, like a startup company that have not raised capital before, and somebody invested in your company, they would get a 50% relief. However, if it's a early stage company that maybe has raised EIS capital before, it would be a 35% relief. And then if it's like a really established company, maybe that has raised EIS capital before and has been trading for a long, long time, it's 20% relief. So it's company depending, but as you can guess, it's obviously risk depending as well. The companies that are offering a 50% relief are a bit more unproven. In Alpha Wealth, we always try to work with companies that are established, have a track record, are not new to market, and ideally have been approved for EIS funding before. So it's likely that most of the companies that we're recommending this year might be in that kind of 35% bracket, which look isn't bad. It's only 5% off what it was last year. We probably would be unlikely to look at any companies in the 50% bracket, just given that there's no track record there, unless we were very, very comfortable with what we've been seeing or what we saw.
Sorry, just one more quick question on EWS. What is the risk with EWS? You've kind of covered this, but just...
Yeah, the risk, of course, is that the company fails in that 5-year period, but it doesn't impact your tax relief. So, for instance, if you were to invest in 5 Mile Concepts this year, who are giving 35% relief, in a way, 65% of your investment is only at risk because you're getting 35% back through the revenue rebate. So the risk, of course, is that if their 5 Mile venture fails, shuts down in that 5-year period, your capital is at risk, like any investment, of course. And so just to kind of, get to wrapping up, guys, the summary, of course, is that balance is key. It's about looking at what you're trying to achieve over your life and making sure that you're availing of the best options for all of those objectives. So, for instance, if you plan to put away a particular portion of money for that short-term period, stick to, deposits and savings accounts, your bank, your credit union, on Post, your Revolut Vault, whatever works for you. There are, however, new to market, fantastic deposit opportunities that a lot of people still aren't aware of. Raisin Bank and Trade Republic are 2 regulated deposit providers that are giving rates in the region of 3 to 4% guaranteed, and they are backed up by a deposit guarantee scheme. So if you are somebody that has money sitting in a credit union account or a Bank of Ireland, let's say standard savings account that's been sitting there for years, you don't need it, it's earning close to 0%, you would be nothing short of mad not looking at some of the options like the Raisin Banks and the Trade Republic, where you can get, guaranteed 3 to 4% per year versus maybe the 0% that you're currently getting. I suppose the downside, of course, is that none of these options will keep pace with inflation. So if we are putting away money for that kind of medium to long-term period, we can look at funds like the Zurich Savings Funds or equivalent, or maybe for a small portion of investments, the EIS scheme. And then, of course, if we're planning to put away money for a very long period of time, for age 50 beyond or to the point of retirement, it's about putting that money to a pension. And I suppose our job in Alpha Wealth is to help clients, get that right balance in terms of where their money is going and make sure that they're getting to access to the best options in each one of those brackets. As I mentioned earlier, we do and encourage everyone to do a full financial planning consultation with us, where we will, save or make clients thousands of euro and ensure they're set up for the process. Our once-off fee, which covers all subsequent meetings and advice and setup of any plans, if it's applicable, is just 199 euro. And there are a lot of similar companies out there that are charging up to 1,000 euro. What that essentially entails is, helping you build a financial future where you're in control, understanding the leaks and gaps in your current financial situation, and we'll establish short, medium and long-term financial goals and provide independent projections on savings and pensions to help you get there. Look to increase your savings and your disposable income by switching to cheaper policies and rates on your main financial outgoings, and give you a bit of assistance with budgeting if needed. We can provide, tailored investment solutions as an impartial broker as well to help get your money, working harder, and give you that dedicated support along your investment journey, and ensure you're operating as tax efficiently as possible to put more money back in your pocket, whether that's looking at, EIS or pension or various reliefs that you're not claiming. And important obviously as well is, ultimately always trying to get people to this ultimate goal of financial independence, where you have the power to give up work if you need to. So look, thanks to everybody for taking the time for listening to me. Look, I hope you got some benefit from that. We will be sharing the details and the recording and stuff with people. But look, if anybody is interested in getting in touch, my own contact details are on screen there. I will maybe open up the webinar now to some questions if anybody wants to pop them into the Q&A or route if there's some questions in there already.
Yeah, there's just one from earlier. I have an old pension from a previous employer. What would you recommend to do with it?
So what we can do is if you get in contact with me, okay, if you just drop me an email on dlooney@alphawealth.ie, I can send you a document called a letter of authority. And if you sign that and fire it back to me, this comes with no costs or obligations. I can send it away to your existing provider and we'll review that pension for you. You know, we look at where it's invested, how it's doing, what scheme it's in, and most importantly, what are your options. But as I said, one option that might be really beneficial is to explore transferring it into something called a buyout bond or a personal retirement bond, which would basically give you the ability to access those funds from age 50 onwards. Whereas if it's in an old company scheme, you might not be able to get your hands on it until, let's say, 60 or 65 if you don't do that. So yeah, drop me an email. Look, and we can certainly explore that for you.
And sorry, just another question, David. What does a financial consultation provide me?
Um, it's all the above basically. I suppose how my process usually works is we'll get an initial meeting in the diary. Prior to that initial meeting, I'll send you an email to gather a bit more information on your personal and financial situation. We'll discuss everything during the initial meeting, you know, set out your financial objectives, you know, what's your situation, what do you need to plan for, and we will go away then and put together a financial plan or a recommendation on how we believe you can improve your situation and achieve all of your financial goals in life. And it might be a case then of tying in with you on, you know, subsequent separate, you know, calls or meetings to discuss putting those plans in place, and we provide that kind of ongoing support and, you know, monitoring throughout somebody's financial life cycle. I'm not in the business of, you know, meeting someone once and saying goodbye. It's about creating long-term relationships with all our clients and providing that lifetime support to them.
And sorry, just one more question. Would you recommend switching mortgages at this stage, or if on a tracker mortgage, or too late to get a good rate now?
It depends, okay. Sometimes it's a case of whatever makes you sleep at night. Like if you're paying a tracker rate of 5.5%, then maybe you qualify for a green rate, fixed rate, and you can switch down to 3.65%. It might make sense to do so. Some people might prefer to hold off and see what happens with tracker rates. I think it's likely that they might come back down, but if you think that they're going to come back down to the degree that, you know, you've benefited from for many years now where it was zero or you were paying a rate of 1%, those days are gone, unfortunately. You know, at best I think it might come back down around kind of, you know, 3% for you. But again, look, we can provide that advice because the advice for everybody, everybody will be different. Like, you know, particularly if you only have a couple of years left in your mortgage, let's say there's 5 years left in your mortgage. If I could move my 5.5% tracker down to 3.65 for those remaining 5 years, I'd probably do it, because it could take another couple of years before tracker rates come back down below 3.65%, you know.
I think that's the last question.
Perfect. Yeah, so look, I mean, if there's no more questions, as I said, if anybody wants to get in touch, you know, to have a one-to-one discussion, more than happy to help. Look, thanks to everybody for taking the time to jump on. Look, and wishing you all the best of luck for the year ahead.